All right. Well, welcome everybody. It's great to see so many joining us again for what I think now is session number 9. We've been doing these every Thursday at 2 o'clock Eastern, and having a lot of fun. Chris Keefe and I with just one amazing panel after another, as we've been exploring how the COVID-19 pandemic and the reaction to it has affected our markets, our economy, the places that we live, and spent quite a lot of time, taking a dive through each part of the market and thinking a lot and talking a lot about what the future holds. And the theme seems to have been that there are a lot of trends out there that were present before this pandemic that have really been accelerated by this pandemic. We explored cybersecurity, healthcare, education, technology. We really made our way all the way around. And in preparing for real estate today, and we really have a phenomenal panel here, we're very excited about that. We realized that real estate in some ways ties together a lot of what we've been talking about over the last 9 weeks. So looking forward to a great discussion on our panel here. Let me introduce to you who's going to be on here. And then, as always, we're very happy that our partner, Nighan, is with us again this week to answer your questions about PPP. And every week feels like a month in that world, and things continue to change, and guidance continues to be updated, and more laws passed. So we're very grateful that we have Morgan here to break it all down. And as she has each of the other weeks, she will be answering your questions all the way through the program. All you have to do is type them in. We're also very happy to have Colette Dafoe, another partner of Chris and I, and Morgan with us. She works in our real estate practice and is the managing partner of our Washington, D.C. office. So we're very happy to have Colette here. Dirk Hrobsky is an executive managing director at Cushman and Wakefield's Manhattan office, actively working with private equity companies, landlords, and operating companies active in every industry from technology, finance, and supply chain logistics. So we're lucky to have Dirk with us today. And rounding out the panel to talk today about commercial and residential real estate is Michael Franco, who is a very impressive man. He's the CEO of SitusAMC, a leading provider of consulting, outsourcing, talent, and technology services to institutional lenders and investors in commercial and residential real estate, and has some tremendous insight from where he sits in the market, seeing access to hundreds of thousands of loans. So very excited to have Michael as well. And then rounding out the panel here today is one of my favorite people in the whole world, and one of my favorite Navy SEAL friends, Jason Kuhn, who's making his second appearance here. Jason was with us for week 2. And Jason has been writing and speaking about how to motivate your workforce where some or all of your workforce is working remotely. That's a topic we're hearing more and more about. So we're very fortunate to have Jason here today, who will give you some insight into how to motivate your workforce working remotely. So Jason, thanks for joining us again today. All right, well, let's Chris, I think let's just jump right into it. I'm going to turn it over to you, and I know you've got some questions for Morgan, and let's kick this thing off.
Terrific. We've actually got a couple of very, very timely updates about passage of some legislation just before we got onto our webinar today, and we can jump right in. So Morgan, looks like the House just approved the PPP Flexibility Act, and now that will presumably work its way on to the Senate and for potential signature by the administration. What do we know at this point?
Yeah, that's right, Chris. Never a dull moment here in PPP land. That just happened just a couple minutes ago. The House passed it 417-1, the Paycheck Protection Program Flexibility Act. And it has a couple of changes in it. It would extend the 8-week window to 24 weeks, which is a huge change. And it would also change the 75% rule down to 60%. But, that's just the House having passed that now, so it has to be also passed by the Senate. The Senate's out this week for Memorial Day recess, so it wouldn't probably get to a vote in the Senate until next week. And, it's more promising than the HEROES Act, which passed the House. It was kind of dead on arrival by the time it got to the Senate, because this is a standalone bill. It's bipartisan. But, you know, the thing that kind of counts against it, the two supporters of the bill, they're not really in Senate leadership. The Democrat is Dean Phillips from Minnesota, and the Republican is Chip Roy from Texas. So it's really up to McConnell to schedule a vote on the bill. And our understanding is that he's kind of more interested in some tax relief issues and maybe not necessarily in making additional fixes to the PPP program. So we have to wait and see if the Senate decides to pick this up. But it's certainly a good step in the right direction that the House has passed it. So we'll look forward to more news on that next week.
And Morgan, Dirk Hrobsky here. I was curious, after seeing de Blasio's announcement relative to the ability for groups not to be personally obligated to leases in New York City, I wonder if that was done in conjunction with this announcement. Do you have any perspective on that?
I don't. I haven't been following that closely. I'm here in Boston, so I haven't been up to speed as much on the New York issues. But what have you heard about that?
It's news to us. I mean, as you read it, it seems for the most part to be focused on retail, which of the three food groups, so to speak, as I focus on retail, office, and industrial, seems to be focused principally on retailers. I don't know, though, if that will be more broadly applied to office and industrial. It's a major issue. Obviously, it is a big problem for lenders. It's a big problem for owners. From a credit quality standpoint, from institutional to smaller organizations, more mom and pop, it certainly will be supporting the smaller organizations that principally occupy Class B and C buildings. So we're very curious to see how this law is applied.
Morgan, if I could jump in here, the loan forgiveness obviously is the most important issue, right, on everybody's minds right now. Since we talked to you last, the new interim final rule came out. Can you shed some more light on loan forgiveness for us?
Sure. I think for the last 9 weeks, we've been, anxiously awaiting the day that we would get these regulations. So they finally have come out. The last time I was on, we just had the application form, and I went over a lot of the basics in that webinar, so I'm not going to repeat myself on those points. But the interim final rule does give some clarity on how certain employment decisions affect loan forgiveness, which I'm just going to run through quickly to highlight for you folks. It's now clear that if you have an employee who you fired for cause, they voluntarily resigned, or they requested a reduction in their hours, that won't count against your loan forgiveness now, and so long as you document it in writing. So that's really significant. And then further, if you make, we knew this before, that if you make a written offer of rehire that's rejected by the employee, then that won't count against your loan forgiveness either. What was added in the regulation is a reporting requirement that the employer has to undertake. They have to report that the employee rejected that written offer to their state unemployment insurance office within 30 days in order to be eligible for that exemption. So that's a fairly significant point that you want to make sure that you're taking that step if you do want to try to exercise that safe harbor there for the loan forgiveness reduction. But I do recommend for folks to, again, I made this recommendation last time. If you're a PPP borrower, print that application form out, read it a couple of times. It's got a really detailed instruction form to it and a lot of calculators that you can use to work through how the loan forgiveness will work in your specific situation.
Morgan, last week we got a lot of news about the review process and the $2 million threshold. Anything new on the review process this week?
Great question. So the same day the loan forgiveness reg came out, another reg came out about the review process. And that makes clear the SBA has discretion to review any loan that it chooses, regardless of whether it's $2 million or above. There's that FAQ that says that loans under $2 million will still be deemed to have made their certification in good faith. That's still the case, but it doesn't mean the SBA can't still review your file if it decides to do so. And they tie that review ability to the 6-year document retention requirement. So they're basically saying, we retain the right to review any and all loans for 6 years. So keep your documents and we may come ask you for them at some point. And the way that will work, they'll notify the lender, and the lender then has 5 days to notify the borrower that the SBA is exercising its right to review a loan. and they'll review for initial eligibility, and they make clear that the guidance that was issued on the day you applied for the loan is the guidance that will apply to your eligibility determination. They'll review how you calculated the loan amount, how you used the proceeds, and how you calculated the forgiveness. And they make clear there'll be an opportunity to have a dialogue with the SBA and to respond to their questions, and that there'll be an appeal process, and they will put out another interim final rule about the appeal process at some time in the future. So stay tuned for that.
Thank you, Morgan. One last question for you before we move on to our real estate panel. And for those of you listening in, please, if you have questions, go ahead and type them in. Morgan's going to stay on and answer your questions. Morgan, I know you're tracking. There's a number of lawsuits that have been filed against the SBA. Interested to hear, any updates on those lawsuits and what you're seeing?
Yeah, this is a topic near and dear to my heart as a litigator, obviously. The one case I think is most significant, I did talk about it last time, it's the Diamond Club of Flint case, which is a gentleman's club in Detroit that was denied a loan because it's on the SBA's list of ineligible businesses that was incorporated by reference into the interim final rule. And I've been making the argument all along that that's an invalid agency rulemaking exercise because it directly conflicts with the text of the CARES Act, which contains no such restrictions on eligibility. And the district court agreed with that argument, issued an injunction, ordered the SBA and the lender to give these businesses that filed a lawsuit a loan. The SBA appealed to the Sixth Circuit. So anytime there's an injunction issued against the federal government, they have a right to ask for a stay pending appeal, and they did that. And the Sixth Circuit denied the SBA's petition and let the injunction stand and ordered the banks to provide the loans. So that's really interesting. And there was a strong dissent, I will say, from the Sixth Circuit. There was one judge that dissented pretty strongly. So you're going to see this is going to percolate up in different states and different federal circuits, and there's going to be different opinions about, reasonable people can disagree about the right way to interpret the statute and the related guidance. So we're going to be, keeping a close look at how that plays out and how that might affect different issues going forward.
Terrific. Thanks, Morgan. Morgan, we're going to move on to Michael, Franco, and Dirk and Colette. Michael, let's start with you. You've seen a fair number of PPP loans over the last couple of months. I think we were chatting that you've been to about 125,000 so far. I'd love to get your thoughts on overall what you're seeing in the program.
Yeah, we've been actively involved with a number of financial institutions, both on the fulfillment side and actually doing quality control work, on the back end. What people, and you probably have covered this, but what people forget, it's a government, lending program, which means you could be subject to the False Claims Act. So, have you properly determined what the loan amount is? We're seeing a lot of inconsistencies in that. We have like 9 different lenders that we've worked with on that. We've seen a lot of issues as you go lender to lender and the consistency in the way that they did the calculations, and also changes just over the time series of when they did it. And a lot of those lending institutions, look, they were caught in an unenviable type of position. They were looking to leverage their existing staff. You've heard, Bank of America, other banks say we're not going to have any layoffs. Here, well, what does that mean? It means that they're taking the greeters in the banking institutions, the people, the tellers. I've even heard cafeteria workers who all of a sudden are, now you're a PPP loan officer. And they're calculating the loan amount that's going out because you got in 100,000 applications and you're supposed to get those out the door as fast as you possibly can. So we've seen a lot of inconsistencies in the program, and we think that, personal view, lenders should get the same safe harbor type treatment that borrowers did in some of these cases, to go back and make changes to the loans because they tried to act in good faith here to comply with the program. But when you've got 47 different, FAQ points that are coming out, and I think we're in the high 20s in terms of amendments, to the program at this time, it's hard to say that you got everything right all the way along the line.
Michael, you heard Morgan give us an update on the House bill that passed. What are you predicting, though, for more, laws and so forth coming out of Washington?
Yeah, so it's been really difficult for us because we actually stood up a portal here to calculate all the loan forgiveness amounts and do the due diligence on the forgiveness piece. So we have a full, functioning web portal, and it seems like every week we have to redev, a significant portion of what our offering is to comply with the new regulations that are coming through. I would expect changes. And, one of the key things, I think that people missed the point of what PPP was really trying to do. PPP was originally just trying to say, oh my God, we're going to have massive, unemployment, and it's going to start rifling through really quickly. Let's just give people money and, tell the employers, don't lay off anybody, just keep on paying them. Don't worry about the expense because we got it. We, the government, we have it. And it went from being a paycheck protection plan, into a small business savior act, which it was not really intended to be. And that's where, the politics of it really start coming into play, because we've moved now to it's not saving enough small businesses. And once you're going in that way, you might as well just write off the whole thing as a grant, because that's going to be the point. It's going to be the reward for owning a small business in America act. And I think a lot more of these loans are going to end up being forgiven, which, by the way, is what the lenders want. Because from everybody that we've talking to, what the real concern is that, let's say that your institution made 100,000 of these loans, and let's say that you even thought, as the Congressional Budget Office did, that you were going to end up with 92.5% loan forgiveness because that's what they put into the budget. That doesn't mean that you're going to have 92.5% of those loans go away. You might only have 50% of those loans go away because the proceeds aren't properly utilized, and then you're left collecting, for 2 years, a 1% loan to a financially strapped borrower in a political, hot potato type program. Nobody wants, to deal with that. And by the way, what you get paid for that is very, very minimal. So if you have a bunch of $1,000 loans, I think you get $35 a year to do all the collection activities on that 1% piece of paper, that you get the privilege of holding. And that's also why the Fed came up with its lending facility at 35 basis points, because it realized for a lot of these smaller institutions, they're tying up their capital on 1%, loans for 2 years that we're making them make. So I fully expect them to make it a more liberal program for the sole purpose of making the forgiveness wider, because it's going to benefit the financial institutions more. And it's an election year, and who wants to be out there taking things away, from small businesses and potentially consumers?
Michael, to that point, if I may, it seems like what you've outlined is exactly in line with what I've just heard today, really over the past week, about Mayor de Blasio and this new law, which effectively will enable people to walk away from their lease obligations and not have any personal liability, and not to politicize things. But I think it's exactly analogous to what you've just outlined, but the real estate version of it. If you're allowed to walk away from your obligation and not have your personal liability, again, that's affecting smaller organizations. You're not talking about the larger corporates, those with lesser credit quality typically. Those are the ones that, frankly, are just going to be able to, in theory, again, I haven't read the law. It's not yet been signed as far as I know, but that's going to put a real hurt. It's going to become a major issue for owners and for lenders, and you're really going to see some changes, I think, in the Class B and C product of office, also retail, and then industrial. But it's surprising that this was pushed through so quickly. It's going to be a real issue to contend with, especially on the lending side.
Yeah, and we do primary servicing on about $100 billion, worth of assets here in the U.S. and special servicing on over $40 billion, of assets on the commercial real estate side. And we definitely think that the ramifications, the unknown externalities of all these programs are definitely going to have some major effects on the market, and we just don't know what those are yet. But we also feel that PPP has been a major benefit to the commercial real estate market because of the 25%, as it currently stands, that you can take and apply to either rent or, mortgage payments. And it's kind of a de facto stimulus to the commercial real estate side to push it out for a little bit. So we've been talking with a number of the servicers who've said that performance activity, collection activity, has been better than what they anticipated and actually has trended up in some areas because the smaller borrowers have been the ones who've been able to get the PPP loans. So it's been interesting, but, as that wears out and you start getting into the ramifications of what you're talking about on, no personal guarantees, the ability to walk away from leases, it's going to have a longer-term impact.
Yeah, and I specifically think the constitutional nature of this law is going to be questioned. I haven't heard much discussion about it yet, but a lease is a binding contract, a personal guarantee the same. That's often seen in the form of a good guy guarantee in a lease document, and the constitutional nature of this new law is definitely going to be something that is the number one topic people will be focusing on, I'm sure, over the next several months. Very curious to hear what Morgan or Colette, your perspective is on something like that.
Sounds like a government taking to me. I mean, they're taking a property interest. I don't know how you could get it. I mean, that's gonna be interesting how that plays out. I'm sure it'll be challenged like tomorrow.
It's already in the HEROES Act that was passed effectively because they applied the right to ask for forbearance to all loans. They extended it beyond the GSE loans to all loans in the HEROES Act. So if that was to ever get ratified, you've got already on the residential side an impairment of contract law across all residential mortgages, in the U.S. So if you're willing to do that and go after all residential mortgages in the U.S., then, attacking the commercial borrowers, not as big a deal.
The same thing is going on in California too, with the Senate Judiciary Committee advancing a bill last week that is this sort of small business savior bill, but it's got to get through. It's got to get through the rest of the California legislation. So I think you really do have to take into account all the unintended consequences here, and I think you've all mentioned it. I am all for small businesses. I mean, here in DC, I've heard a number of times that we may lose up to 40% of our restaurants, just given the current state of things. So I would love to see some help for them, but in the event that there's help, there's got to be help up the chain, right? There's got to be help to the landlords and property owners, and then what do you do with the lenders? So there has to be, I think, a much more all-encompassing approach, and I'm very interested to see when that comes out.
40% is surprising to me. I've not heard 40% on the retail side, more 25 to 30. But to Michael's earlier point, we have seen performance in specifically Class A buildings in the 90-95% range. So retail falling substantially more than that wouldn't be surprising, but 40% sounds like a lot. I think again it depends on credit quality of the occupier at the retail level. Very curious.
And maybe this is a jump ball for the group, but how has the market behaved with respect to forbearance and accommodation in this time as compared to 08, 09? I know, Colette, you cut your teeth on workouts during that period. You and I were going through that lovely experience together. And maybe we'll start with you. So what's different this time around so far?
Sure. I mean, I think there's a number of things, but I think first, it's so dramatic this time around in terms of the industry specific hits. I think that you've heard it already, and I think you've all seen it, but hospitality, these care industries that that are very they're very complex, right? An office building is one thing. So back in 08 and 09, I think lenders, the servicers had an appetite for enforcement. Right now, obviously, given the pandemic, there's, as you heard earlier, there's these 90-day forbearances, sort of this like hold off a little bit. But when we get to the end of this 90-day forbearance, I'm very interested to see what kind of appetite lenders really do have to enforce their remedies and actually foreclose. I mean, I'm sort of expecting to see maybe a lot of loan modifications, I think, for sure, but also maybe a real specialty area in receiverships where these receivers have a very specific focus and can handle some of these, really, I think, complex and quality care type industries. And we just didn't see a lot of seniors housing defaults in 08 and 09, and we may this time around.
I would say if it's a jump ball, I'll grab it. I would say that in the credit crisis, it was specifically banking that was impacted. This is a global health crisis that's uniformly impacted every group out there, and I think that it's a much is situation, not only in terms of size and scale, but the duration is like nothing anybody's ever seen before, and hopefully we never see again through investment in science. But I think it's proven, on this phone call, dogs barking and bleeps and beeps going on from phones. Like, being in person is unique, and I'm probably the most boring person on this call since I focus just on real estate, office, industrial, retail. But all groups are being impacted. The least impacted is supply chain related to industrial. But from an office standpoint, a retail standpoint, the health crisis that we're going through right now is like nothing before, and people are just starting to get their arms around getting back to work. How do we get back to work? What does that look like? What does it look like going to a restaurant? You can't. I've seen a lot of articles calling, for this is the end of commercial real estate. There's not well, if you believe you're not going to go back to work, then people aren't going to be going to the beach. They're not going to be traveling. They're not going to be going to concerts, out to dinner. They're not going to be doing anything social. So I don't believe that at all. I'm much more bullish on our future, as a nation and as a global society. But we've got to figure out what the new workspace looks like, how people interact, and things will be very different. It's a behavioral reaction that we're dealing with. It's not a financial situation. So, behavior is a tough thing to deal with. Growing up as a son of a psychologist and studying psychology in college, behavior is a tricky one because every one of us on this phone call has different behavior and we all react differently. So I think anytime you're dealing with a behavioral situation, it's particularly tough.
And Chris, can I just jump back in on one point? I think
Please.
One other major difference here is, as Dirk mentioned, the banking industry kind of brought everybody and everything to a halt. I mean, I was a primarily developer investor counsel at the time, and then I was a workout attorney overnight. But now I'm still doing deals. We're still doing deals. People are still moving forward. There's obviously things are taking longer, but there is I think a cautious optimism that exists this time around that definitely didn't back then.
Colette, and I think you're right. Things are very different. I want to ask Michael to help us sort of to explain and sort of break this down for us a little bit, because Michael has a unique perspective of what's really going on behind the scenes and what commercial services are doing and so forth. So Michael, give us a glimpse as to what's going on behind the scenes there.
Yeah. Before I jump into that, wanted to actually comment on a couple of things. Dirk, I mean, what you were saying, there, I definitely agree with. People, we tend to operate in extremes and run in those directions, and not think of things holistically. So to say, hey, all commercial real estate is dead, you're spot on. Okay, well, what else does that mean for everything else in your life that you're assuming is also completely changed and different? And let's be consistent in what your worldview is. Like, let's not assume that one thing is going to be completely dead, but everything else is normal. So you need to have a consistent view, and I think a lot of people don't necessarily, do that. As far as what we're seeing in both the residential side and the commercial side, in the commercial servicing, we do the servicing ourselves, so we know what we're doing in our book. We're very fortunate because we deal with a lot of trophy assets and not a lot of the smaller type of deals. And what we're generally seeing working with our banking clients and working with those types of assets is definitely a push for forbearance for 90 days just to see how the world kind of emerges, from this. But then from there, we're already starting to see a real bifurcation in property performance. Some of the hotel assets that we have are actually looking like they're going to have good Junes and Julys and Augusts, if you could believe that. Occupancy has been tipping up. Average daily rate at the hotels have been, pretty good. And a lot of those are places that are maybe alongside a beach in a California or a Florida where people would have, previously potentially flown to Hawaii. And now they're saying, hey, why don't we go to, this resort, here. So we're hearing those types of assets being at 60%, occupancies, with average daily rates that are at pre-COVID levels. And those properties are going to be able to resume, debt service coverage here in the third quarter. And then we have other properties that are asking for 12 months, 18 months of forbearance, where they're not anticipating being able to pay debt service, for a long period of time. So we're already kind of seeing that break, in the market. And I think lenders are really focused on, they understand that there's going to be distress in a property, but they're very focused on, does this owner want this asset? Are they willing to backstop, this asset? Are they going to put in more money? Are they going to support it from a capital perspective? Or am I essentially just giving you a free option, right? Like if you're asking me for 12 months and it's a rework of the loan and you're going to put in some additional capital, I could be flexible with you potentially on that. But if you're asking for a free option and you just want 12 months of forbearance, like, okay, essentially I own all the downside risk as the lender and you get all the upside risk as the borrower, that's not an equitable, deal. So we're definitely seeing, a lot of those types of transactions, and the lenders are bifurcating, like, who are my good borrowers, what are my good assets, and what are the ones that I know I'm going to have, problems on almost immediately. That being said, performance has been better in many areas than people would have originally thought. And, as you take a look at the April remittance cycle, kind of March's rents pay for April's, payments. So because March didn't see a fall off of the cliff, April, a lot of properties still performed. As we got into May, we started seeing some additional slippage, but it still wasn't, terrible. And the story in residential has been that people were asking for forbearance and then not necessarily using it. So in the first round of forbearance here, we're up, I think we were at 50% of the people who asked for forbearance actually made their mortgage payments. And we price somewhere between $5 and $6 trillion of mortgage servicing rights, here. So we've got a very good insight through that work on what the overall, market is doing. It's about 50% of the overall, mortgages in the U.S. that we price from an MSR standpoint. So we get to see the underlying performance. And we saw it go from 50%, of that uptake on forbearance. The next month it was only 30%, meaning that the people who asked for forbearance, 50% of those people made their payments the first month, but then only 30% did. And you're kind of seeing that, what is it going to be this month? The people who asked for forbearance, maybe it's only going to be 10% of the people who asked for forbearance that were able to make their payment, as we kind of filter through it. On the resi side, if I can move there quickly, look, you've got the government sitting in between, and when the government is making the rules for you, there could be a lot of externalities, very quickly, in there. And there's been a big change in the way that this market operates between the last financial crisis and this financial crisis. I mean, we are just about as much nationalized on the housing side as you could be without having a full, nationalization, right? I mean, you've got 80–90% of new loan activity essentially going through, GSEs, in some form, Fannie, Freddie, Ginnie, FHA, VA, USDA, make up a massive percentage of the market overall already. The private label securitization market away from, GSE executions is relatively small. That was a market that never got back to peak volumes or anywhere close to it. We were north of 1.2 trillion in the last crisis. We were south of 100 billion, here last year. So pretty big differences in the overall size and importance, of that market. And on the resi side, I think that there's going to be this big push, and it's already been rolled out, that you can miss your payments. We're just going to take it and put it on the back end, of the loan. And the speed of the recovery is really going to ultimately determine what type of opportunities that there are on the default side, in residential. There's a lot of investment capital in the last downturn that went after residential assets. But here you see a real political will and pressure to even out that cycle, right? Not allow foreclosures, not allow evictions, give people the right to forbear for, longer periods of time in order to normalize. So you may not end up seeing the level of distress on the back end in resi because nobody wants to impact that consumer again, especially not in an election year. And that's certainly a lot different than, what we had previously, where there was all that capital going after it. There was all those mortgages that were away from a government execution, and there's more freedom in kind of your executions.
Michael, I think it's really interesting, your point on residential, which is not my forte aside from the place I live. But on the commercial side, we've been on 10 phone calls a day with different occupiers trying to help get them relief. And the one thing on the commercial side that sounds so different than what you just described is the requirement for an occupier to provide their financials, audited financials, to show their hardship. Obviously, there's a lag in financials. So April 1 was D-Day. That's like, all right, who's going to pay their rent, who's not? May 1, who's going to pay their rent, who's not? People are performing much better than you think. But on the commercial side, they've got to provide the financials. They have to have proof that they need help in terms of rent forbearance, which is what is so alarming about Mayor de Blasio's, I guess, proposed law. If you do give people the right to walk away from an obligation without proof of hardship, without protecting the owners and the lenders, it's just hugely alarming, and again, brings up constitutional issues in a very material way. But I do think, listening to you, the striking difference is proof of hardship versus, not having to provide proof. It's a stark contrast and something that's very different. Many of our clients have asked for forbearance only to say, well, I don't want to show my financials. Why would I? I'm a big hedge fund. Why would I want to show my financials? I don't do that. Nobody knows my financials. So it's a stark contrast, and I think very interesting difference between the resi world and the commercial world.
Yeah, one of the things that I definitely wanted to expand upon a little bit is externalities, right? We've kind of talked about a couple different areas, but the externalities here, the government response is creating a lot of unique and potentially long-term impacting overlays to the way you think about markets. So when the government has the right to come in and alter your contractual rights, that just increases effectively the cost of capital, right? Because now you need to price in an additional risk that didn't exist there previously. And again, taking this more to the residential side because it's consumer-based, and that's where you're going to see the impact, the most. Well, the private markets were already struggling with, gaining footing, versus the government, who already has a massive cost of capital, advantage, and you've just potentially added to the risk premium associated with private capital, which is just going to push further nationalization of the residential market because you've increased the disparity in cost of capital, cost of funds between a private label execution or just a private market execution and a government, execution. And it's going to potentially be the same thing in commercial, right? The risk premiums have to expand if there's an ability for contract law to change in ways that you never anticipated that it potentially would. And one of the areas that I really want to highlight here, because I don't think that people understand this is one of the great, untold, stories so far of this crisis, is kind of the Fed response, here in the agency mortgage market and all the ramifications that it had. So going back to why did the Fed step in and say that they were going to buy, agency mortgages effectively as much as they needed to, is because the market just stopped functioning, right? So they had to come in and they had to do something to get it to function more properly and to narrow the risk premium between the 10-year and where mortgages were going off. And they came in and they did that, and they did that in a pronounced, major way, and it really widened those spreads. That was great, but they did it so quickly that a lot of those originators who are non-banks and don't have depository funding, they hedge their pipelines. And they hedge their pipelines by essentially shorting the TBA. The Fed came in and bought the TBA. That shot that price up, causing massive margin calls that almost put out of business all of the main originators who are non-banks in the country, because they were getting hundreds of millions or even billions of dollars of margin calls within a week. And then you hear on CNBC, oh, the Fed isn't going to be as active. You know why the Fed wasn't as active? Because some of the major banks reached out and said, guys, we've got warehouse lines to all of these major, lenders out there throughout the country. You're going to cause all these guys to fail. We get that you're trying to normalize the market, but they need time to pull through their pipelines and sell and effectively reset, all their hedges. Just a great example of the externalities that could be created when, the government's looking to do something that's going to be positive. They're trying to help, but sometimes it ends up creating more problems. The same thing here on the forbearance side within the CARES Act. It's terrific to help people out who need help on their mortgages. But if it's a no proof standard and anybody can get it, now you've created this additional risk that people need to price in. And, when Fannie and Freddie say, yeah, we'll buy your mortgage that, needs forbearance as soon as you originate it because, that person lost their job, but we're going to charge you 700 basis points. Now, as a lender, you have to rethink the lending decisions that you're making. And what you're seeing is that the boxes at a lot of major financial institutions continue to shrink. So, what has that CARES Act done? Yes, it is, essentially help people who needed it on the forbearance side, but it's also shrunk the amount of, people who have access to mortgage credit. And it's increased the spread between the 10-year and where mortgages are currently trading at. So that's why there's a lot of externalities to all these policies. We don't fully understand them. The PPPs are going to be another great example here with whatever ends up happening. What does that mean for small businesses? And we just are in a very unique period of time because the political will to do all these things is kind of, unmatched. How quickly we're moving this time versus any time, in the past. You've never seen Congress and the Fed be so aligned to, spray money out into the economy and rewrite laws. So we'll see what the end results are.
Yeah, Michael, thanks for explaining that to us. That's really amazing. I can't believe how fast this panel is going by, Chris, and we could probably have to do another whole hour just on this panel. We need to go to Jason here in a minute, but I want to ask Colette, just to give us a minute on the future of commercial real estate. What do you think that looks like?
After everything we just talked about. So, I think this is going to be such a lawyer's answer, but it's going to depend, right? It's going to depend on how long we're in this situation. The longer that we're in this situation, the deeper the impact will be and the harder this will feel. But there's things can change in every different, I think, aspect of real estate. We could have we could have a movement out of cities. I mean, just anecdotally, the numbers that are leaving the cities just because of their public health concerns in the city are huge. Leases could shorten. It's just extremely unpredictable right now. But I have a feeling that workout attorneys are going to be fairly busy in the upcoming months.
Yeah, thank you, Colette. Appreciate that. So this great panel discussion here. We've been getting a lot of questions from all of you about, how do you motivate a workforce if not all your workforce is going to come back to the office, and some of them are still going to be working remotely. If folks are now figuring out that, some of our workforce can work remotely, and so we don't have to pay for that, that 5 floors in New York City or Los Angeles or Chicago. That's going to lead to all sorts of issues that come up. And retired Navy SEAL Jason Kuhn, who has a company, Stonewall Solutions, has been thinking a lot about this and talking about it, Jason. So we want to go to you and start just, sort of with a general question of, how do you keep a remote team on track when they're working remotely?
Yeah, sure. Thanks. And thanks to the other panelists. I've got a bunch of notes here. I was writing down, so my head was down the whole time. And I'll try to relate as much of this stuff to you guys as I possibly can. So we talk about keeping a team on track. There's a couple of things that I think about in relation to what was discussed is it's not just performance, but it's also in terms of, moving down that track, where are we going and how do we regain momentum? Because that's really what we lost, as far as, a standard of hardship and whatever. I'm in the same boat. If the government's going to give me money as a small business owner, I'm going to take it, right? But what I've really lost is momentum. And that's what we have to figure out how to rebuild, because even if that money keeps coming in over and over again, at some point they're going to run out of our money and we got to run our businesses. So that's what we want to do, is regain momentum, and we regain that through performance. But our environment has also changed. Now we're working remotely. We're not interconnected and don't have that regular human interaction that we would normally have. And we got to build ourselves from the stopping point and adapt to, whatever it is we're dealing with all sorts of conflicting and ever-changing information. So it's a real challenge. So what I try to do with people is, one, help them understand what performance is. We're not talking more so about your individual employees, your sales teams, your people that are at home who are trying to manage teaching their kids. They're trying to manage all the things of everyday life as well as perform well at their job. And then us as business leaders and business owners. So performance to me is really, really simple. And it's an ability to execute fundamentals under extreme stress. So no matter what was going on around us in the environment of combat or training, we would focus on what we can affect or what we can control. And then that produces best outcome. In any competitive event, if you view your business and the environment you're operating in as competition, that's ultimately what it is, just like combat. It's just the stakes are raised. You can't force outcomes, right? If you could, and you and I competed against each other, we would both win if we could force it, and you would have wanted everything you've done, and therefore competition wouldn't exist. But you can produce best outcome by focusing and demanding a pursuit of perfection of everything within your control. And so fundamentals to me are controllable actions of value. But the key is to understand they exist not only in how we do what we do. So how I sell something, how I build something, how I shoot my weapon, but also in mindset and culture, how I think and how we treat each other on a daily basis. So having people understand, one, what is our standard of performance, and then how do I perform? And the standard, I used to base mine in comparison when I was a college baseball player. I wanted to be better than everyone else so I could get playing time. And when I got into the SEAL teams, it changed. It wasn't, can I get better than the competition? It was, how good can we get, right? That was what we wanted. We wanted to maximize potential. And that's what we want to do with our workforces is, hey, we know we're in this new environment, but how can we maximize the potential of ourselves and every employee that we have and adapt accordingly? And then understanding and training them and what those mindset and cultural principles are because as the environment changes, I believe the principles of success are consistent. They don't change, but certain ones become more relevant and certain ones become more challenging than others. So when we're working remotely through a computer, teamwork is obviously more challenging than if we're all in the same room together. So those are ones that we need to focus on and ones that we need to build as we go through. But in the general sense, to wrap up how do you keep a team on track? One piece of advice I would give people is when you're managing and leading your teams is have them understand what performance is, have them understand what's expected of them and clearly communicate it. And I would make it more task-oriented than time-oriented, right? So a lady asked me one time after a keynote virtually that I gave, and she said, well, how do I homeschool my kids? And how do I put in 8 hours a day at work? And how do I, I was like, you can't, because you're trying to invent time. There's 24 hours in a day. You don't find time, you prioritize time. So what you need to do is dedicate your time blocks to certain things and give yourself 2 or 3 things to accomplish today that you know you can get done for work. And 2 or 3 things you want to get accomplished with your kids. But you can't be a full-time teacher and a full-time salesperson because it's impossible. So managing those expectations of what people think that you're expecting of them, right? And clearly communicating that to them so they know what it is they need to accomplish to receive the affirmation and move forward from us. And that's the first thing I'll tell you. Communication on the battlefield might be our biggest ability. In the SEAL teams, it got pounded into your head that you will communicate properly no matter what's going on around you. And I think it was our biggest asset, or one of them. And it's the first thing to break down in untrained. You can see it. And it's the first thing to break down in the corporate environment too when things go south. And that's another challenging situation with working remotely is communication can break down very, very, very easy. So communicating what the standard is, how to perform, and then what that performance looks like, I think is vital to keeping people on track so that we're not all going off in different directions.
So Jason, when you talk about, so let's assume that the organization does a good job of sort of setting expectations and accommodating sort of the multiple buckets that people are trying to balance and being clear about that communication. It is also true that this environment requires a lot of self-motivation and that requires a lot of mental toughness. And how do you sort of encourage people to build mental toughness and apply that in a remote work environment?
Yeah, right. So as I mentioned with fundamentals, I believe they occur in mindset and how we treat each other, and then how we do what we do. And so what I'll tell people a lot of times, I can teach you how to jump, dive, and shoot, but that doesn't make you a SEAL, right? I've got to know that you can respond to adversity. And that's what I believe mental toughness is an ability to respond to adversity properly. And it's not an abstract concept that means something different to me and to you and whoever. I believe it's a skill that can be learned and applied in our lives. And that's what I try to teach people to do. And mental toughness, to me, is a shift of focus, right? So when adversity hits, when something's uncontrollable and unfair, it makes me feel a certain way. I feel frustrated. I feel angry. I feel whatever. Well, those emotions may or may not benefit my next action. So I don't want to let the emotion, whether that's the fear of COVID-19 and contracting it, or whether that's the fear of, am I going to have a job next week or whatever it is. The fear is valid, right? When something happens on the battlefield, a bullet whizzes by your face or something, that emotion's initially environmentally driven. But once you've ingested it, then you have a choice. And reacting upon that fear is probably not the best choice. That's probably not going to produce best outcome. You want to think, you want to shift your focus off of that fear, off of that thing that happened, and back into 2 things, the process and the people around you. What do I need to do to win the fight in front of me? So the better standard we have in preparation, the more clearly that standard is communicated in terms of performance, the easier it is to shift our focus back into that process. So for me, as some of you know, have heard me speak, there was a call that went out one time when I was pinned down in a fight. They said I was pinned down in a fight, and I was able to shift my focus back into what I need to do to win this fight because of the preparation, because I knew what was expected of me. so on and so forth. And then shift your focus into the people around you, because when you shift your focus into others, anxiety goes away, right? Anxiety it all comes from self-concern. What's going to happen to me? Am I going to die, right? The more I'm concerned about my teammate, the less that has anywhere to live or feed upon. So and that's what I looked over at my teammate and I saw him fighting, and that goes away. So that's what teach people's mental tough people, but people need to learn this as a skill, because if I say, what is mental toughness to you and to you, everybody gives different definitions, right? So it's understanding, hey, I'm in an adverse situation, and now I need to shift my focus off of it and into the best possible solution, the process, and into the people around me. But it's something that has to be taught. But the good thing about it is, regardless of background, it is something that can be learned. Anyone can be tough. It's just a skill like anything else.
Jason, you're talking about shifting that focus, on each other. For you, it's on your teammates on the battlefield, preparing for those battles. For us in the corporate world, it's on our colleagues, And so shifting that focus on our colleagues, how do you maintain a sense of team and unity when we're not actually seeing each other in person?
Yeah, so that's one of the skill sets, or the fundamentals, if you will, the team first mind, that I think is most difficult, because we are remote, and it creates a couple of challenges. The remote workforce does. What we're losing is that natural human connection. So I think a team first mind can be trained, but mostly when you're young. You lose it. You learn it as a value or a virtue, right? And some people have it later on when they're an adult. Some people don't. And you're only going to pound it into somebody's head so much. Their character traits are pretty much there. But as an adult, there's two ways I think that we gain the team first mind. And one is through just that natural character. This person believes it as a proper thing. So I say you need to start with the right people. So through your hiring processes and who you're bringing around into your businesses and things like that, start with the right people who value this. So you're at some point on that spectrum now with where you're at. And the other thing is through natural human connection. And that doesn't happen in our big meetings where we're going through the bullet points and laying out the numbers. That happens at lunch. That happens in our conversations in the parking lot. That happens, in the conversations we're having before the meeting starts. And all of those are gone. We don't have that anymore. So there are some ways we need to be more intentional about it. In the teams, we had a swim buddy. So if something went wrong, my first thing to do was to go to this person, and his was to come to me. And our mission in life was to set each other up for success. But that was designated. It was predetermined who that person was. You can do things like that. And then communicate the value of a team first mind early and often. I already mentioned how it helps with anxiety. Another thing is it creates very proper motivation, very pure motivation. And I explain that through an example. If I give people an opportunity to come fight me, and they can have the status of being, having taken down a Navy SEAL, most people don't want to do it. But I say, if I had the person you love most in this world behind me, and you had to fight me to come get to them, would you fight me now? And they'll say yes. But the problem didn't change. It's still me and whatever they assume my ability to be. And one they'll fight, and one they won't, because in one they're not motivated enough, and in the other they are. And that motivation comes through the love they have for that person. But that love didn't just happen. It came through a standard of expectations that were met over the course of that relationship. Now, obviously, that's not going to be like a platoon who trains every day to go to war, or a family member, that you live with every day. But you can create the same sort of thing within your team at work. It's a matter of meeting certain expectations that are predetermined. It's trust. It's doing what you say you're going to do, and everyone doing that. And so you just have to be more intentional about it. So not just having meetings remotely about work, but maybe we go around on our Zoom chat one time and you just talk about personal things. Nothing too personal, but some personal things. What's something interesting everyone's done this week, whatever. But setting aside some time for those things so that you're regaining that connection that you're losing naturally in the everyday workforce. And there's a whole host of other ways and different things. But I think one, communicating the value of a team first mind, and then one, trying to kind of implement some of the connection that we've lost through that naturalness that occurs in everyday life.
Awesome. Jason, thank you so much. Thank you for your service. Thank you for being here today. It's an honor to know you and be your friend, and it's really amazing to hear you speak. Stonewall Solutions, which I think is just stonewallsolutions.com. Is that the right website?
Yeah, Stonewall-Solutions, or just Google it. It'll pop right up.
Yeah, there you go. If you want to hear more, learn more about what Jason is writing about and speaking about, and Colette and Dirk and Michael and Morgan, it's always great to have you here. Chris, you want to do a quick wrap up here at the end of the hour?
Yeah, thank you again to all our attendees. You have made us what we are, which is subsequent to SGN's sale to CBS Viacom, one of the most successful feel-good, good news programs on the internet. So thank you all very much for your continued support. We've got a couple of events coming up. On June 11th, we'll hold the final of our Opportunity Zone webinar in our three-part series. You can join members of Nixon Peabody's Opportunity Zone working group as they continue to explore the practical application of the Opportunity Zone rules and deadlines that you need to know to take advantage of this really significant program, ideal for a sophisticated investor or developer. In case you missed it earlier today, we held a TCPA compliance webinar that provided a comprehensive roundup of TCPA developments and tips for best practices to mitigate risk. As always, you can access our previous webinars and many of our client alerts and sign up for future alerts at our website, www.nixonpeabody.com. And you can also subscribe to mailing lists on there as well. Finally, as I'm sure many of you are doing, our employers are sort of working around the clock to formulate plans to reopen our business. Our dedicated labor and employment NOSHA teams have spent thousands of hours unwinding the complexities of that people will be facing, and feel free to reach out to any of our team in that regard. Keep current on all that sort of guidance on our website, and please reach out to Phil or me if you'd like to learn more about any of those issues. So thanks again for everyone's attendance. We look forward to seeing you again soon.
Thank you, everybody.
Thank you. Thank you, Jason. You still on here?